Hey guys, it's Dave from Lions Den Trading with you for a free course, the best technical trading strategy and rules for 2025. This is what we're going to cover today. We're going to cover an 8-part technical trading strategy that you can implement in order to focus on making gains in the market in short-term momentum day trading. And then we're going to talk about 6 trading rules. Now, with each of these things, you can adjust according to your own preferences and knowledge, but this is what has worked for me, and this is what a lot of other traders say works. And at the end, you're going to get access to a free download with the spreadsheet that I'm going to show you in a minute in the Discord server. So let's get started. So this is actually what the spreadsheet looks like. The trading strategy here with 8 factors involved, and then the trading rules that I've come up with in order to help correct mistakes that I've made and to refine my focus. So you're going to get access to that. So what we're going to do is, number one part of the strategy is that we're going to go long. This is a long momentum strategy. Why do I choose long? Well, it's because it's always available. Unlike short selling, there's not always shares available for shorting, so you can't always enter short. But long, you can always enter long. There's always shares to buy, so that's one of the advantages of it. There's also unlimited profit. So when you go long, you can make 5%, 10%, or up to 1,000% or more. With a long strategy. So there's unlimited upside to the long strategy. So that's a definite advantage. The third thing I like about long is that there's limited risk. That means that you can only lose 100% of your investment. So chances are you're going to lose less than 100% unless you hold it to 0, which almost never happens unless you're trading options. But so there's limited risk. So you can define your risk to 10%. With short selling, there's unlimited risk. So because a stock can go against you, and you can lose more than your initial investment. So that's why the long strategy has limited risk. So here's an example of a long trade. This is actually on PROK that just happened. And as you can see, I followed my strategy of buying just after news was released, and my entry was really good, but I held it for about an hour, and it popped up and then came down, and so I basically got shaken out of this trade because I wasn't exactly sure where it was going. I didn't fully understand just how bullish the news was. They had clinical trials that they had passed in one of their drugs. Anyway, so I sold for a small profit, but as you can see, throughout the rest of the day, it did nothing but go up and reached a high of $5. And I entered at 95 cents. So had I done better on this, that was an extreme profit situation. Nonetheless, I did not lose money. So this is one that got away. But this is an example of a long strategy. So the other part of this strategy is we want to find a stock that has a catalyst, clear bullish news just released, and use this icon because that's what shows up in the scanner. And the more recent news, the better. So it's better to get it. It's better to be first in line if it's bullish news, and then as it gets disseminated throughout the day, more and more people come on board. And that's how price appreciation can happen. So that's part of the strategy as well, is to buy as close to the news release as possible. And we want real concrete news results. So that's another thing you have to learn, is how to interpret and gauge, well, how bullish is this news? How good is this news? How concrete is it? Is it about results, or is it more fluff? And so we want to avoid that fluff news. So here's an example of... Here's a concrete news. This is real bullish news. XYZ Corp reports Q2 revenue of $150 million, up 28% year over year, with 0.45 dollars earnings per share beat. So that's a really concrete performance-based headline that's bullish. And this headline includes measurable financial metrics, a time frame, and comparison data. It gives investors something tangible. It's very tangible. So this is concrete. So this is a check mark. That would be good news. Here's an example of fluff news. It's not concrete. XYZ Corp positioned for strong growth with new strategic initiatives underway. So it's very vague. There's no numbers, no percentages. This headline sounds optimistic, but offers no numbers, timeline, or proof. It's vague and promotional. And so that's what we want to avoid. That's kind of fluff news, and that's not a good catalyst. So the other factor that we want to consider in this long strategy, part of this strategy is we want to target low price, low market cap stocks, otherwise known as penny stocks, low float stocks. And to be more precise, this is in the range of 50 cents to $20 range. This is where you're going to get a lot of volatility and upside, and where you're going to make big gains for short-term momentum day trading. So this is the first green day strategy, because we're going to set up a scanner that monitors, okay, what stocks are up today on volume. And so it's otherwise known as a first green day pattern or a gap up. And we want to set our scanners to gap up, stocks that are gapping up 10% or more. And but that gap can be 100% or more, or even 200. Some stocks gap up 200, 300%. So and then they can go on and double and triple even after that. So there's no hard and fast rules, but we put the threshold at 10% or more. So here's an example of a scanner which is set with that criteria. You can see here it's from 0.5 or 50 cents up to $20, and you can see this is what the scanner would look like. And this is actually recent, and you can see, okay, this ABVE is up 142% from yesterday's close, and you can see the volume, and it ranks them. I order it by the percentage change gap up, and so you typically want to be trading in the top range of this, and then monitor, which ones are moving and where the momentum is. So when timing and trading is very important, and peak volume happens between 7 a.m. Eastern Standard Time and 11 a.m. Eastern Standard Time. Now that's not set in stone either, because a stock can go up after hours. It can go up late in the day. There's always exceptions, but in general, this is where most of the market action happens. So 7 a.m. is actually prior to regular market hours. The regular market opens at 9:30 a.m. Eastern Standard Time. So that's 2.5 hours pre-market. So you want to be, well, for myself, I've created this strategy because that's when I can wake up. Pacific Standard Time is 4 a.m. So to meet this 7 a.m. Threshold, I have to be up and watching the markets at 4 a.m. my time. I'm on the West Coast. It can be earlier. Companies do issue press releases even earlier than this, and times can vary. So just note that. And I'm gonna talk about two different variations later on, and how you can deal with them as well. But so watch out for that early news. So here are the periods of trading hours. The pre-market hours is 4 a.m. to 8 a.m. Eastern Standard Time, and then 8 a.m. to 9:30 a.m. is normal pre-market. So this is like super pre-market. This is normal pre-market, and regular market hours are from 9:30 a.m. Eastern Standard to 4 p.m. And then there's after-hours trading all the way up to 8 p.m. Eastern Standard Time. So you subtract 3 hours from each of these for Pacific Standard Time. And what I'm saying is 7 a.m. is a good time to start monitoring the market. I mean, you have to decide for yourself when you can trade and when you can watch the market. And that differs for everybody. But in my strategy, in this strategy, it's from 7 a.m. up until about 11 a.m. Eastern Standard Time. That's when most of the volume happens. So the other factor that we want to look at is volume. Is volume coming in? And just after news, there tends to be a volume spike, so an increase in volume. And we want to look at minimum. I set it to minimum 200,000 shares. And the reason why is I want to see If you set it too high, if you set it to 1 million or 10 million shares or 5 million shares minimum, you're going to miss that first period just after a stock has released news and the volume is just starting to build and come in. So I set it pretty low to 200,000 shares. And if it's really bullish news, that's going to be met pretty quickly and pretty easily. And with this criteria, you're going to be able to get very fresh news. So a stock that issues a news release at 7 a.m. and then immediately you'll see 100,000, 200,000 shares traded, or even 500,000 or even 1 million, like very, very quickly. And you can still see it within the first 1, 2, 3 minutes of after the news. So this is why I choose this 200,000 minimum volume. And if it's a really hot stock and this is bullish news, this volume is going to surpass 1 million shares, 20 million. In this market, it's going up to the hundreds of millions of shares on some of these low float stocks. So you're going to see that increase very quickly. So there's two strategies, and the number one best strategy I have seen in the market is going long within 10 minutes after the news has been released. So the earlier the better, and it makes sense, right? Because the longer you wait, the more it disseminates and the more people buy in, and the higher the price goes and the more riskier it is. So I would say try to get in as early as possible. If you see a stock that has just released news and it's bullish and you know it's bullish and you have a good feeling for it, it's on trend, you're seeing volume coming in, that's when you want to buy that first dip. If you can get in that first dip, just like that PROK that I showed you, getting in that first dip, I mean, you have the potential to make, maximize the gain using this strategy. So buy the first dip within 10 minutes after the news. So it works best for news releases at around 7 to 8 a.m. Eastern Standard Time. And typically you want to hold until the market open or hold for the entire day. All stocks are different. It can unfold at a different rate. As I showed you with PROK, they kind of held it down before during market hours. They really took it up. So this is not a machine. Market makers play tricks. The algorithm plays tricks on you. And that's part of the challenge. So the number two best entry, or the number two best strategy in this long strategy, is within the first 90 minutes of news. And with this strategy, what I've found is that even if you wake up early, 7 a.m., some companies will release news at even earlier, like 3 a.m., 4 a.m., and then they'll receive that first initial jump up in volume. But if it's consolidating coming into the peak market hours, which starts at 7 a.m., and it's forming a triangle, or it's basically flat, that's a good entry, because as more and more people wake up and the news disseminates again, you typically get another spike up, and even more, several more. So this is the second best entry, and this is for if you encounter companies that release news earlier and you get confused because you're like, oh, he said, oh, you want to get in as early as possible. You got to be in the first 5 minutes or 10 minutes. Well, don't worry. If it's consolidating and it shows the right pattern, then you can also enter there for more upside. So it works best for news releases at 5 to 6 a.m. Eastern Standard Time, and you're joining later. And but with these, it may peak pre-market, because there seems to be this tendency that, the earlier they release the news, the more likely it is that they're just going to want to really rip the price up and then kind of take away the long trade before the main market. That's what I've noticed with this type of trade. And that's why it's number two, because it's not really... It's trickier, basically. So that's the number two best entry. So the other thing you want to watch with these is watch for short shares available, because if it's gapped up and it's consolidating and there's all these short shares available, then a squeeze might happen, because a lot of people might say, oh, okay, well, the move is done, so I'm going to enter short. I'm going to try and get in short on this. And as all these short sellers pile in, they squeeze it up and force them to exit, and that creates that big volume spike. So that's the second strategy. And you also want to watch the technicals, the exponential moving average, simple moving average, and the MACD, to monitor that, to make sure if you're going long, you want to make sure that the price is above the simple moving average and the MACD is still positive. If you get the MACD crossing over, or it dips below the SMA and it stays below, that's a very bearish sign. So if you see those, that means that volume is coming off, momentum's coming off, and it's a riskier play. So what about some rules? This is the bonus of this video, trading rules. Now you want to differentiate between trading rules. Your rules can apply to all different strategies. So you can have a short selling strategy, you can have a long strategy, you can have an option strategy, multiple strategies. But you want to have set rules that apply to all your trading. And so here's some trading rules that I came up with for myself, which I've developed based on mistakes that I've made and what other traders recommend as well too. And you can constantly update these and change them, but you should also be reviewing them constantly in your mind so that you have a structure in place that helps you to focus on your strategy and on consistency. So here's the trading rules that I follow. Trade one strategy only. Long only for me, and no short selling. So one strategy only. And typically most trading educators recommend this. Get good at one strategy, one pattern, one setup, whatever it is. Just focus on that. Don't try to become an expert on multiple strategies at the same time. That's very advanced and it takes time. So for a beginner, or could be a career trader. Some career traders just say, this strategy works consistently. It has for years. So why do you need to branch out? You don't need to branch out. I mean, I guess maybe if you're bored, I don't know. But rule number one, trade one strategy only. Rule number two, for me, keep share size small. So manage your risk. Okay. You don't want to go in 100% or even 50, 60, 70%, unless you have like extremely good conviction. But it's not a good habit, because you're trying to manage your euphoria and your emotions, and you want to have it so that you're not constantly jarring yourself emotionally when you're trading with like extreme highs and lows, because that can sap your energy, and you have to remain calm and rational. So controlling share size and your aggressiveness is very, 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 very important, especially when you begin. Now, once you get consistent, you might increase your share size as you become more confident, as you get a good setup, and that's typically what traders do. But then, if you get aggressive for a period of time, you can get overconfident and you got to pull back or you're going to get hurt. Anyway, this rule is trade 1 to 500 share size only, and that's only 20% of accounts. So that's a small account, $2,500. And it's a $500 position essentially. And you might think, oh, well, that's not going to move the needle. I'm not going to make enough money. But like I showed you, some of these stocks, these low float stocks and penny stocks, they can go up 50%, 100%, 1,000% in a day in short periods of time. So that can result in money, and it adds up fast. You can get $100 to $500, $1,000 gains in very short period of time. And the point is, you want to get consistent at getting those base hits or those triples, those doubles. And then, after a month or a couple weeks, once you've done this, you're going to double your account. And then you can start looking at slowly adjusting your share size. So keep your share size small. Trade one active position only. That's a rule that I follow, because you want to keep focused. You don't want to be monitoring multiple active trades at the same time. Maybe you can handle it, but I personally find that this is better when you have this constraint. Number 4, plot support and resistance and use your technical indicators. This is to prevent you from FOMOing in. Okay, if you try to get in after a stock has spiked, you get FOMO, you get fear of missing out, and you're making an emotional trade. The way to combat those types of impulsive emotional trades is by doing your technical analysis, plotting your support and resistance line, and don't enter until it hits that support, until you have a good base of support. And that might not happen if a stock spikes pre-market, like this happened with BTCM. It spiked pre-market, and then it did nothing but stair step down all day long until it found a floor at about 490, and then it surged up to 660. So it requires patience and discipline, and doing your analysis. If you missed a trade, I mean, either just walk away or be prepared to take a long break, and don't pull the trigger. Do a full analysis and just wait until you're calm, wait until it's quiet, wait until you just know you have a high probability trades. So that's what our technical analysis is for. Number 5, define your risk and keep your stop loss of about 10%. So in a $500 position, you don't want to be losing. You want to be risking $50. So stop loss of 10% or less. And those are the trading rules. You can add more. But as I said, I'll put a link in the description below if you want to join the Lion's Den trading community. It's totally free, and we're just there to support one another, chat, share information about stocks, and we've got traders in there already from around the world. Really good prop trader from Turkey. I have some friends in there that are new traders. And we're getting traders coming in from Twitter. So anyway, it's new. It's a free community, and I invite you to join Lion's Den Trading. Link is in the description below, and that's where you can get a link to my spreadsheet where you can adjust your own trading rules as well. So thanks for tuning in, guys, and we'll talk to you later.